Welcome back, everyone. Welcome back to Professor Jiang Files. If you've ever watched the news during a financial crisis and walked away feeling like you understood even less than when you started, this channel exists precisely for you. Take a moment to like and subscribe. Independent analysis that actually respects your intelligence takes time and research to produce, and your support is what makes it possible. Now, let me ask you something. Every time an economy collapses, whether it's 1929 or 2008, or the dozens of smaller crises in between, every major newspaper, every economist on television, every textbook in every university gives you the same explanation. The bubble got too big, people got too greedy, optimism became irrational, and then gravity. What goes up must come down. It's the boom-bust cycle. It's capitalism doing what capitalism does. Nobody planned it. Nobody engineered it. It just happened. That is the dominant narrative. And I want you to hold it in your mind for a moment, because today we are going to dismantle it. Not with conspiracy theories, not with fear-mongering, not with dramatic predictions about imminent collapse. I want to be very clear about that up front, because this topic attracts a lot of noise and very little light. What I am going to give you today is a structural argument backed by history, economic mechanics, and documented behavior, that financial crises are not purely accidental events. They are, in many cases, the predictable outcome of an incentive structure that benefits concentrated financial power far more from instability than from steady growth. And I want to go further, because understanding how the system works, how interest rates actually function, how central banks actually coordinate, what really happened in 2008 and who actually profited, will give you a completely different framework for understanding not just the past, but what may be coming next. By the end of this video, you will understand the actual mechanics behind financial collapse, who benefits and why, how the 2008 crisis was not simply a case of too much optimism, but of deliberate positioning, and what the structural warning signs look like today. Stay with me, because the first point I want to make is the one almost nobody talks about, and it has to do with what money actually is. Here is something that sounds simple, but is actually one of the most disorienting truths in modern economics. When you deposit $1 million into a bank, the bank does not keep that $1 million. It lends it out. Now, if I take in $1 million and lend out $1 million, simple arithmetic says I have zero, right? That's just math, but that is not how banking works. Under the fractional reserve system, the bank effectively has $2 million. The original deposit on its books as a liability and the loan it issued as an asset. The bank has, in a very real sense, created money, not printed it physically, but created it functionally through ledger entries. Now multiply this by tens of thousands of banks operating simultaneously across a national economy. And suddenly, you have a system where money is not a fixed resource, but a living, breathing, expandable abstraction. It is a collective agreement, a shared hallucination, if you want to be blunt about it. The moment enough people stop believing in it, it behaves very differently. Now, here is where most analysts stop. They explain fractional reserve banking, pat themselves on the back, and move on. But there is a second layer to this that is far more important. How do thousands of banks, all operating independently, all making their own lending decisions, coordinate with each other? How does the system know when to expand and when to contract? The answer is the interest rate. And what I want to suggest to you today is that the standard explanation for what interest rates do is incomplete. You've been taught, and I was taught this too, that interest rates guide consumer behavior. When rates are low, people borrow to buy homes. When rates are high, they don't. Simple supply and demand of credit. But there is a second, more structural function of the interest rate that doesn't get nearly enough attention. The interest rate is a signaling mechanism directed primarily at banks themselves, telling them whether to increase or decrease the flow of liquidity into the system. When rates are low, banks make lending criteria easier. More money flows. The economy expands. When rates are high, lending standards tighten. Liquidity contracts. This means one entity, the central bank, has the power to determine whether an economy breathes in or breathes out, whether it expands or contracts, whether it booms or eventually busts. And this is where the question becomes geopolitically significant, because there is not just one central bank. There is, above all national central banks, an institution that most people have never heard of, and that institution coordinates them all. Let me tell you about the Bank for International Settlements. The BIS is based in Basel, Switzerland. It was established in 1930. and it operates, in the words of financial historians, as the central bank of central banks. Every major national central bank, the Federal Reserve, the Bank of England, the European Central Bank, the People's Bank of China, participates in the BIS framework. It is the institution through which central banking coordination happens at the global level. Now, most analysts will tell you that the BIS is simply a forum for coordination, a technical institution that helps prevent currency crises and ensures financial stability, and that is partially true. But here is what they're missing. The BIS is not a public institution in the conventional sense. It is not democratically accountable. It operates with extraordinary opacity, and its history reveals something that should give any serious student of geopolitics pause. During World War II, and this is documented, this is not speculation, this is in the historical record, the BIS continued operating as a financial clearinghouse for Nazi Germany, a Swiss-based institution, technically neutral, facilitating transactions that allowed the Third Reich to purchase raw materials, Swedish steel, Romanian oil, Portuguese tungsten, from neutral countries. The argument made explicitly by financial historians is that Nazi Germany needed a financial channel to maintain its war economy, and the BIS and the broader architecture of transnational finance provided it. Now, after the war, one might expect such an institution to be reformed, restructured, or dismantled. Instead, it became more powerful. The post-war economic order, rebuilt under the Marshall Plan and the Bretton Woods framework, placed the BIS at the center of international financial coordination. What does this tell us? It tells us that transnational capital, the concentrated financial architecture that operates above the level of individual nation-states, does not operate according to the moral frameworks that the rest of us use. It operates according to a different calculus entirely. Not good versus evil, not democracy versus authoritarianism, but activity versus inactivity, profit versus loss, movement versus stagnation. And this is the key insight that unlocks everything I want to tell you about 2008 and about what may be coming next. Let me take you back to the years leading up to 2008. For anyone who has lived through an economic crisis, the feeling is unmistakable. You watch the news, you see experts saying everything is fine, and then overnight, it isn't. Millions of people lose their homes. Retirement accounts evaporate. Unemployment spikes. Families that built something over decades find it gone in months. And the explanation we were given was the bubble popped. Too many people took on too much debt to buy homes they couldn't afford. The subprime mortgage market collapsed under the weight of its own excess. It was gravity. It was inevitable. Here is the structural story that sits underneath that narrative. In 1999, the Clinton administration repealed the Glass-Steagall Act. This legislation, passed in the 1930s after the Great Depression, had maintained a strict separation between retail banking, the kind where you deposit your paycheck, and investment banking, the kind where institutions make high-risk bets with capital. The logic was simple and sound. If you're holding ordinary people's savings, you cannot gamble with it. The repeal of Glass-Steagall combined these two functions. Commercial banks became investment banks. The institutions grew enormous. And enormous institutions require new financial vehicles to generate returns at scale, because once you're managing hundreds of billions of dollars, you cannot simply put it in safe government bonds and call it a day. You need products. Enter the collateralized debt obligation, the CDO, the financial innovation at the heart of the 2008 crisis. Here is the basic structure. Banks issued mortgages to homeowners. They then bundled thousands of these mortgages together into a single financial instrument. This instrument paid investors regular income, the monthly mortgage payments of all those homeowners. And because people generally pay their mortgages, these instruments were rated as safe by credit rating agencies. At the same time, enormous capital flows were coming into American financial markets from abroad. Japan was running what economists call the yen carry trade, borrowing money at near 0% interest from the Bank of Japan and investing it in American treasuries paying 5%. The Gulf states were recycling petrodollars into American assets. China, Europe, pension funds, everyone wanted exposure to the American financial system, which was perceived as the safest and most sophisticated in the world. All of that money needed somewhere to go. CDOs provided a destination, and the appetite for them was insatiable. now. Most analysts will stop right here and say the system collapsed because too many homeowners defaulted on loans they couldn't afford, too much subprime lending, too much optimism, gravity. But here is the question that this explanation never answers. The banks held these mortgages. If homeowners were struggling to make payments, the banks had a choice. They could foreclose, take the house, sell it, take a loss, or they could roll the loan over, extend the timeline, modify the terms, keep the system breathing. Banks do this all the time. The private credit markets do it today with trillions of dollars of corporate debt that would technically be in default if creditors demanded repayment on schedule. Bubbles do not have to pop. They can be sustained indefinitely, as long as the institutions holding the debt choose to sustain them. So why did 2008 happen? Here is where the narrative gets genuinely uncomfortable. And I want to present this carefully because the evidence points in a clear direction, but I will not overstate what can be proven. John Paulson. If that name is not familiar to you, it should be. Paulson was a hedge fund manager who, in 2007, made what became known as the greatest trade in history. He bet systematically, deliberately, and at enormous scale that the American housing market would collapse. He purchased financial instruments called credit default swaps, which function like insurance policies. If the mortgages they referenced defaulted, Paulson would be paid out. In 2008, when the housing market collapsed, John Paulson made approximately $20 billion in a single year on a bet that the system would fail. Now let me walk you through the logic of this slowly because it matters. Imagine you hold a portfolio of mortgages. Some of your borrowers are struggling. You have a choice. Work with them, keep them in their homes, sustain the system, or accelerate the defaults. Push borrowers toward foreclosure. The system collapses, but you've already positioned yourself to profit from the collapse. The loss becomes your gain. This is not speculation. This is the documented mechanics of the instruments that existed in 2008. The credit default swap market created financial incentives to trigger defaults rather than prevent them, and the aftermath confirmed the pattern. When the dust settled, individual homeowners had lost their properties. The major banks that had issued the worst instruments, Bear Stearns, Washington Mutual, Wachovia, were acquired at fire sale prices by healthier institutions. J.P. Morgan, led by Jamie Dimon, emerged from the crisis substantially larger and more powerful than it entered it. The consolidation of the American banking sector accelerated dramatically. Think about what this means in human terms for a moment. Behind every foreclosure notice was a family, a couple who had saved for years for a down payment, a first-generation homeowner who thought they'd finally broken through, children who had to change schools because their parents lost the house. The 2008 crisis was not an abstraction. It destroyed real lives, real communities, real futures. And the evidence suggests those losses were, at least in part, the predictable consequence of a system structured so that a small number of actors could profit from the catastrophe. If you've been watching financial news over the past decade and trying to make sense of what's happening, who the real players are, what's driving the decisions that affect your life, that frustration is exactly why this channel exists. Subscribe, share this video with someone in your life who deserves better analysis than cable news is giving them, and stay with me, because this next section is where the real strategic picture comes together. Let me zoom out now, because 2008 was not just a domestic American story. It was a global inflection point. The crisis exposed serious vulnerabilities in the Western financial model. European banks were heavily exposed to American mortgage securities. Global trade contracted. The IMF revised growth forecasts downward across every major economy. And yet, China's economy kept growing. Now, most mainstream analysis attributes this to China's massive stimulus program, to its infrastructure investment, to state-directed lending. And all of that is true. But there is a structural dimension to this that rarely gets examined. In the years following 2008, the Chinese renminbi began a sustained appreciation against the US dollar. This is significant because exchange rates, like interest rates, function as signaling mechanisms, but at the international level. A strengthening Chinese currency tells the world China is a safe counterparty. China can purchase your exports. China's economy is creditworthy. It directs the flow of global capital and trade toward China rather than away from it. Look at the data from this period. In 2008, Chinese bank balance sheets were roughly comparable in size to major American and European banks. By 2024, the four largest banks in the world by assets are all Chinese. China's share of global manufacturing exports went from significant to dominant over this same period. Was this entirely organic, perhaps? Chinese industriousness, Chinese state capacity, Chinese long-term planning, these are real factors and they deserve credit. But the structural conditions that allowed this expansion, the currency dynamics, the capital flows, the international financial coordination, did not happen in a vacuum. They were shaped by the same transnational architecture that had shaped American expansion a century earlier. The lesson from history is consistent. The center of economic gravity does not shift by accident. It shifts because the infrastructure of global finance, the central banks, the clearing mechanisms, the exchange rate signals gets redirected. The British Empire's financial model shifted to America in the early 20th century. American financial dominance shaped the post-war world. The early 21st century has seen a partial shift toward Chinese manufacturing and trade volume, even as the dollar remains the world's reserve currency. But here is the tension that defines the current moment. China has not become the hegemon, and it appears, at least for now, that it does not want to be, at least not in the traditional sense. Being the world's reserve currency means more than economic power. It means military bases in 100 countries. It means being the lender of last resort to the world. It means absorbing the political costs of global governance. China has expanded its economic footprint enormously, but it has not replaced the dollar. It has not replaced American military dominance. And it has not sought to restructure the global financial order in its own image, at least not yet. This leaves a genuine open question at the structural level. Where does transnational capital go when the current anchor, American financial and military dominance, begins to show its limits? Now, most analysts will look at American decline and stop there. They'll say, America is weakening, China is rising, the dollar is in trouble, prepare for instability. But here is what they're missing. The question is not simply which nation rises and which falls. The question is how the architecture of global finance repositions itself and what structural conditions it requires to do so. And for that, we need to look at a pattern that goes back to the very beginning of the modern financial system. The year is 1688. England and the Dutch Republic are very different kinds of power. The Dutch Republic is the wealthiest commercial empire in the world. It controls the spice trade. It has the most sophisticated financial instruments in Europe. It has pioneered joint stock companies and commodity futures, but it is militarily vulnerable. It sits on a flat coastal plain, easily invaded, and is under persistent pressure from Catholic France and the Habsburg Empire. England is a military and naval power, protected by water, parliament-governed, Protestant, strategically positioned. The so-called Glorious Revolution of 1688 was, at its core, a merger between Dutch commercial financial sophistication and English military strategic capability. Dutch capital and Dutch financial engineering came to England, and 6 years later, in 1694, the Bank of England was established, a private institution that lent money to Parliament rather than to individual monarchs. This innovation was revolutionary. Before this, lending money to kings was dangerous. Kings died, kings lost wars, kings defaulted. But lending money to Parliament, to the nation-state itself, was a fundamentally different proposition. As long as England existed as a functioning nation, the debt would be honored. And England, sitting behind the Royal Navy, was about as safe a borrower as the world had ever seen. The Bank of England became the template for the entire modern financial system, and it had three core characteristics that persist today. First, profits are privatized, losses are socialized. If England fought a war and won, the financial backers made enormous returns. If England fought a war and struggled, the costs fell on the public, through taxation, through inflation, through the general suffering of ordinary people. The upside was private, the downside was collective. Second, the system requires constant activity to generate returns. Capital sitting idle earns nothing. Capital deployed in war, in conquest, in trade, earns. This is why the British Empire expanded so aggressively in the 18th and 19th centuries. The wars, the Napoleonic Wars, the conquest of India, the Opium Wars in China, the so-called Great Game with Russia over Central Asia were not simply acts of political ambition. They were economic necessities for a system that needed constant activity to service its obligations. Third, open borders for capital. The system is transnational by nature. It needs to move capital across borders to extract value from multiple geographies to diversify exposure. Nationalism, which insists that wealth stay within national boundaries and serve national interests, is structurally in tension with this model, which is why the ideology that traveled with British financial expansion always emphasized free markets, free trade, and the movement of capital. Now, connect this to America. After the Civil War, a small number of financiers, Rockefeller in oil, Carnegie in steel, J.P. Morgan in banking, built industrial monopolies with access to City of London capital. And in 1913, the Federal Reserve was created, modeled explicitly on the Bank of England, a private institution formally independent of the government with the power to set interest rates and coordinate banking liquidity. Within a year of the Federal Reserve's creation, America entered World War I. 15 years later came the 1929 collapse and the Great Depression, then World War II. Then the post-war American century. The pattern is consistent across time and geography. The financial architecture arrives, activity follows, expansion follows, and eventually collapse follows, followed by reconsolidation by those who position themselves in advance. Which brings us to today. America in 2025 faces a set of structural pressures that are taken together serious. The population is aging. An aging society is, in economic terms, a less dynamic one. Less entrepreneurial, more oriented toward consumption of existing wealth than creation of new wealth. This is not a moral judgment. It is a demographic and economic reality. Quantitative easing, the policy of printing money to stabilize the economy after 2008, repeated again during COVID, has created conditions where money is abundant but badly allocated. When capital is cheap and plentiful, it flows into speculation rather than productive investment. Asset prices detach from economic fundamentals. Bubbles accumulate. And perhaps most significantly, America's ability to project military force, the ultimate backstop of dollar dominance and the rules-based international order, is facing increasingly credible challenges. This is not something the mainstream media discusses openly, but the strategic community is very aware of it. When you see these three pressures operating simultaneously, demographic, financial, and military, and you understand the historical pattern we've just traced, the question becomes not if the financial architecture repositions, but when and what that repositioning looks like. Now, most analysts will tell you that this repositioning, if it happens, will be a catastrophe, and for ordinary people, they will be right. Financial crises destroy wealth broadly, not just for the powerful. They create unemployment, poverty, social instability, political radicalization. The 2008 crisis produced the conditions for a decade of political upheaval across the Western world. A comparable crisis today, in a more polarized and fragmented information environment, would carry even more severe consequences. But here is the structural insight that the panic narrative misses. For transnational capital, crisis is not disaster. Crisis is opportunity. The 2008 crisis did not destroy wealth overall. It transferred it. Individual homeowners lost. The institutions that had positioned themselves to profit from the collapse gained. That is the pattern. That is the system. And so the question for serious geopolitical analysis is not, will there be another crisis? The question is, who is already positioning themselves to profit from it? What assets are being accumulated quietly? Which institutions are getting larger while others are being allowed to weaken? What exchange rate signals, interest rate movements, and capital flow patterns suggest a structural repositioning is already underway? These are the questions worth watching, not the noise of daily political theater. Let me bring this together for you. The central argument of today's analysis is this: financial collapses are not random events. They are not purely the product of irrational exuberance and natural gravity. They emerge from a system that has concentrated enough power in enough hands that the incentive to trigger a collapse can, under the right conditions, outweigh the incentive to prevent one. This is not a conspiracy theory. It is an incentive analysis. It is the same analytical framework that any serious economist, any serious regulator, any serious strategist uses, applied to the most powerful actors in the system rather than the least powerful. The 2008 crisis is the clearest modern case study. John Paulson's $20 billion profit was not luck. It was positioning. The post-crisis consolidation of the American banking sector was not coincidence. It was predictable given who had the capital to acquire distressed assets. The shift of economic gravity toward China in the years following was not uncoordinated. It was facilitated by financial infrastructure that operates above the level of individual nations. What should you be watching for going forward? Watch the private credit markets. There is currently an enormous accumulation of corporate debt that is being quietly rolled over rather than called in. When that stops, when the incentive calculus shifts, that rollover ends quickly and the consequences spread fast. Watch the AI investment bubble. The technology sector is currently absorbing capital at a scale that is not supported by current revenue generation. That does not necessarily mean it collapses soon. Bubbles can persist longer than logic suggests. But watch the insider positioning. When the people who built these companies start moving capital elsewhere, that is the signal. Watch the dollar. The dollar's status as the world's reserve currency is not guaranteed forever, but the transition away from it, if it comes, will not be a gradual fade. It will be a structured replacement. Watch for what is positioned to replace it. And above all, watch who is buying what. In moments of structural transition, the most important information is asset accumulation, who is quietly acquiring resources, infrastructure, and financial positions while everyone else is watching the headlines. I want to close with something important. I have given you a structural analysis today that challenges the dominant narrative. I want to be clear about what this analysis is and what it is not. It is not a call to despair. Understanding that systems have power structures behind them is not the same as believing those structures are omnipotent or permanent. They are not. History is full of examples where concentrated financial power overreached, where structural miscalculations led to genuine redistribution, where nations and peoples found new paths when old systems failed. Understanding the system is the first step toward navigating it and eventually improving it. It is not a call to paranoia. Not every market movement is manipulation. Not every policy decision is engineered. The world is complex, actors have competing interests, and outcomes are often genuinely unintended. What I am arguing is that the incentive structure matters, and that understanding who benefits from what helps you read events more clearly. And it is not a guarantee of anything. I do not know when or how the next major crisis will arrive. Anyone who tells you they do is selling something. What I can offer is a framework, a way of asking better questions, watching better indicators, and resisting the explanations that are designed to make you feel that things just happen. In a world full of noise, that kind of clarity is rare, and it is exactly what we try to build here together. The world doesn't need more reactions to headlines. It needs more people who understand the structures behind them. That is what Professor Jiang Files is for. Think clearly, question everything, including what I've told you today. Do your own research, and I'll see you in the next one.